You know that feeling when you're trying to understand something really complex, maybe like a company's inner workings, and you wish you had a specific tool, like a diagnostic check, that just points out the key things and potential issues?
Yeah, exactly. And in the world of auditing, well, there kind of is such a tool.
Right. So today we're doing a deep dive into a really, really important document for understanding what auditors in India have to specifically report on. It goes beyond just the standard financial statements.
That's right. We're looking at the revised guidance note on the company's Auditor's Report Order 2020. You'll mostly hear it called CARO 2020.
And crucially, this isn't the order itself, the law, but it's the detailed guidance from the Institute of Chartered Accountants of India, the ICAI.
Mm-hmm. Think of it like the auditor's instruction manual. It tells them exactly how to apply CARO 2020, what questions they need to answer about a company's operations and compliance.
In this specific guidance note, it was revised in 2022, which sounds quite significant. Why was that?
It was, yeah. The revision basically brought it up to speed with recent changes in company law, especially amendments to Schedule 3 of the Companies Act, 2013.
Schedule 3, that's the format for financial statements, right?
Exactly. And those amendments added new disclosure requirements for companies, things auditors now need to verify and report on under CARO. So it all links up.
Okay, so our mission today is to, well, unpack this guidance note. We want to pull out the most important bits, maybe even some surprising details.
The nuggets.
The specific mandated things auditors must look for and report on under CARO 2020. It's like getting a special X-ray of a company's health.
A very specific X-ray. And just to be clear, everything we're discussing comes directly from excerpts of this specific document. The guidance note on the company's Auditor's Report Order 2020, revised 2022 edition.
Great. So let's start with the basics. What exactly is CARO, and who does it even apply to?
Okay, so CARO itself is an order. It's issued by the central government in India under the authority of the Companies Act 2013. So it's a legal requirement.
For auditors, yeah.
For auditors, yes. And it applies to most companies in India that need an audit under the Act. That includes branches, even foreign companies, if the Act says they need an audit.
But not all companies.
No. And that's important. There are specific exclusions, things like banking companies, insurance companies. Most Section 8 companies, those are usually nonprofits, though there are some exceptions there.
Okay.
Also one-person companies and what the law defines as small companies. The auditor checks if CARO applies based on the company's status at the balance sheet date.
Got it. So for a lot of companies, but not the really small ones or specific regulated types, how does this EIR report fit in with the main audit opinion?
That's a key point. The CARO report is supplemental. It's in addition to the main audit opinion.
So the auditor still says if the financial statements are true and fair.
Yes, that main opinion stays. CARO requires the auditor to provide specific factual information or opinions on a list of predetermined topics about the company's operations and compliance based on what they found during the audit.
And you mentioned the 2022 revision linked up with Schedule 3 changes. Can you give an example of how that works?
Sure. Schedule 3 now requires companies to disclose more detail on things like, say, the title deeds of their properties or how they did asset revaluations or info on benami property proceedings, borrowings.
Right.
And CARO 2020 now specifically asks auditors to report on those exact same things. It ensures auditors are verifying what companies are putting in their disclosures.
So the auditor isn't just, checking the final numbers. They're explicitly tasked with verifying and reporting on these specific operational details.
Precisely. And the guidance note breaks down exactly how auditors should tackle each of the 21 clauses in CARO 2020. It even clarifies that auditors often need extra procedures beyond their standard audit work just for CARO.
Extra work.
Yeah, potentially. The guidance note actually suggests auditors should tell management early on what CARO requires and get written confirmations or representations from them.
Makes sense to get everyone on the same page early. Okay, let's dive into some of these specific areas. What about what a company owns its assets? What does CARO say about records and physical checks?
Right, assets. First, the auditor has to report if the company keeps proper records for its property, plant, and equipment, PPE, so buildings, machinery, and also intangible assets. These records need quantitative details, location.
Even electronic records?
Yes, electronic records count, but the auditor needs assurance they're, complete, accessible, and haven't been tampered with. Then there's physical verification. Management is responsible for actually checking these assets exist.
How often?
For PPE, it should be at reasonable intervals. The guidance says a phased program checking different assets over the year is acceptable.
Okay. And what about inventory? Raw materials, finished goods, that kind of stuff.
Similar idea. Management has to conduct physical verification of inventory, again at reasonable intervals, using appropriate procedures, covering enough of the stock.
All right, now I remember reading something specific here. What if management finds differences when they count the inventory? Like the records say 100 widgets, but they only count 90.
Ah, yes. This is one of those really specific CARO requirements. It goes beyond just normal financial statement materiality.
How so?
The auditor must report if there are material discrepancies of 10% or more in the aggregate value for each class of inventory noticed during the physical verification.
Hold on, 10% per class, not just 10% of the total inventory value.
Exactly, per class. So think raw materials, finished goods, work in progress, each as a class. If the discrepancy in, say, finished goods hits 10% of the value of finished goods, even if that amount is small compared to the total inventory, it has to be reported.
Wow, that's drilling down quite deep. It forces a focus on accuracy within categories, not just the overall picture.
Precisely. It puts pressure on having good tracking and controls for each type of inventory.
And if a 10% discrepancy is found in a class?
Then the auditor reports that fact and also reports whether the company has properly dealt with it in the books of account, like did they adjust the records correctly.
So it's a direct flag on inventory controls at a pretty granular level. Okay, what about bigger assets, like land and buildings? Immovable property.
Right. This links back to those Schedule 3 changes. CARO requires the auditor to report whether the title deeds of all immovable properties shown in the financials are actually held in the company's name.
Excluding leases, I assume?
Yes, it generally excludes properties held under leases where the company wouldn't normally hold the deed and some other specific arrangements. But for owned property, they check the deeds.
Why is that specific check so important?
Well, fundamentally, it verifies ownership. And it connects to other compliance areas like Benami property, which we'll get to, if the deeds aren't in the company's name.
Then what?
Then the auditor has to provide specific details in the report. Describe the property, its value, who holds the deed, promoter, director, relative, employee, someone else, and for how long it's been held that way.
What if the deeds are lost?
The auditor checks if the company has taken reasonable steps, like getting certified copies from authorities, maybe filing a police report, FIR, and they'd get management representations on it.
Okay, still on assets, what about revaluation? If a company decides its land is worth more and writes up the value.
CARO touches on that too. If PPC or intangible assets have been revalued, the auditor must report if the revaluation was based on a valuation done by a registered valuer.
So adding credibility.
Exactly. Using a qualified, registered professional.
Is there a percentage trigger here as well, like with inventory?
Yes, similar concept, but applied differently. The auditor reports the amount of change due to revaluation if it's 10% or more in the aggregate net carrying value of each class of asset that was revalued.
Aggregate of the class.
Yeah.
So if they revalue one building, you look at the total change for all buildings.
Right. Compare the new total value of that class to the old total carrying value of that class. And the guidance also suggests that generally if you revalue one significant item in a class, you should probably revalue the whole class to avoid cherry-picking assets to write up.
Interesting. Okay, you mentioned a link to Benami property. Let's unpack that.
Yeah.
What does CAR require auditors to report there?
This is another specific legal compliance check. The auditor must state if any proceedings under the Prohibition of Benami Property Transactions Act, 1988, have been initiated or are pending against the company, specifically for allegedly holding property as Benami.
And just quickly, what does Benami generally mean here?
Basically, it's where property is legally held by one person, the benominar, but the real benefit and often the payment comes from someone else, the beneficial owner. The Act has exceptions, like holding property for family members within certain structures or in a fiduciary role.
Okay.
CARO reporting focuses on cases where the company itself is alleged to be the benominar, holding property for someone else improperly.
So the auditor isn't investigating this themselves, but reporting if the company is involved in legal proceedings about it.
Exactly. They report if proceedings exist and if the company has disclosed these details appropriately in its financial statements. They'll ask management, check legal expenses, review board minutes.
Standard procedures.
Standard procedures, yes. And the guidance note adds a crucial point. Just sending a letter to the tax department saying this isn't Benami doesn't count as a pending proceeding or dispute for CARO. It has to be formal legal action that's been initiated.
That distinction between a representation and formal proceedings is key. Okay, let's shift gears to money flows, loans, and investments the company makes. What does CARO want transparency on?
This clause really targets potentially risky or, let's say, loosely structured lending by the company. Auditors have to report the total amount and also the percentage of total loans granted that fall into two categories.
Which are?
Loans are advances that are either repayable on demand or granted without specifying any terms or period of repayment.
Like, here's some money, pay me back whenever, or pay me when I ask.
Pretty much. The guidance sees these as potentially risky because there's no clear path or timeline for getting the money back. And importantly, the auditor also has to state the aggregate amount granted under these on-demand or no-terms conditions specifically to promoters and their related parties.
Highlighting potential insider dealings.
Exactly. Potential conflicts of interest.
Okay, so that's about granting the loans. What about tracking repayments for all loans the company has given out?
Right. For all loans and advances granted, including those from previous years that are still outstanding, the auditor checks if repayment schedules for principal and interest were actually stipulated.
And whether they're being followed.
Yes, and whether payments and receipts are regular.
And if they're not regular, what gets reported?
If they're not regular, the auditor must report the total amount that's overdue for more than 90 days as of the balance sheet date.
90 days. Another specific threshold.
It's a standard benchmark for delinquency. And if amounts are overdue for more than 90 days, the auditor also has to report whether the company is taking reasonable steps to recover the money.
Okay. CARO also makes auditors check compliance with specific parts of the company's act itself, right? Sections 185 and 186 related to loans and investments.
Yes, absolutely. Sections 185 and 186 contain rules about loans to directors and about loans, investments, guarantees, and security given by the company. They're designed to prevent misuse of company funds, especially with related parties.
So the auditor reports any non-compliance.
Yes. They check if the company followed the rules, things like getting the right approvals, ensuring terms aren't harmful or prejudicial to the company's interests.
What would be an example of something prejudicial that might get flagged?
Well, the guidance note gives an example. An auditor might need to make an unfavorable comment if, say, the company gave a guarantee without the required shareholder approval under Section 186. Or maybe if they gave a loan at an interest rate way below what the company itself pays to borrow money, or below government bond yields without a good business reason. That could suggest the terms weren't fair to the company.
Right. Ensuring deals, especially with insiders, are actually good for the company itself.
That's the core idea, promoting good governance and preventing value leakage through unfair terms.
Okay, what about another CARO clause, where a company raises loans by pledging securities it holds in its own subsidiaries or associates?
Yes, that's Clause X. If the company has raised loans during the year by pledging securities it holds in its subsidiaries, joint ventures, or associate companies, the auditor needs to report that.
Just the fact that it happened.
They need to give the details of such loans, and they need to report if the company has defaulted in repaying those specific loans.
So specifically, defaults on loans secured by subsidiary shares, not general defaults.
Correct. General defaults on borrowings are covered elsewhere in CARO. This clause focuses just on defaults related to these specific types of pledged securities. It's a simple yes-no reporting on the default aspect for these loans.
Interesting focus. Now, let's talk about where companies get big chunks of funding. Public offers, preferential allotments. How does CARO track the use of that money?
This is a really crucial transparency check. If a company raised money through a public offer, an IPO, FPO, maybe issuing debt instruments to the public,
Right.
the auditor has to report whether that money was used for the specific purposes stated in the offer document or prospectus. And this check applies not just to money raised during the current year, but also any money raised in prior years that was actually spent during the current year.
And what if the money wasn't used for the stated purpose? If it was diverted?
Then the auditor has to report the details. How much was diverted? Where did it go? Were there delays, defaults? And has the company done anything to fix it? It's a direct check on keeping promises made to investors.
What about funds raised privately, like preferential allotments or private placements of shares?
Similar principle. the auditor checks if the company complied with the relevant sections of the Companies Act, sections 42 and 62, which cover things like getting the right board and shareholder approvals, maybe using a registered valuer if assets are involved.
Okay.
And again, they report if the funds raised were actually used for the purposes the company stated when raising them. If not, they report the noncompliance, the amount involved, and the nature of the issue.
There's also a point about mismatching funds, right? Using short-term money for long-term things.
Yes, that's another financial management check. CARO requires reporting if funds raised on a short-term basis were used for long-term purposes.
Why is that a concern?
It's a classic liquidity risk. If you use, say, your overdraft facility short-term borrowing to buy a big machine that will generate returns over many years, a long-term asset, you might struggle to repay the overdraft when it's due because the machine hasn't paid for itself yet. So the auditor reports the nature and amount if this kind of funding mismatch happens.
Okay, now here's one that sounded particularly interesting. Non-cash transactions with directors. What's the focus here?
Right. This clause looks at deals where the company acquires assets from or disposes of assets to its directors or people connected with them, like relatives or other companies they control, but without cash changing hands.
So like swapping assets or issuing shares in return for an asset.
Exactly. Those kinds of transactions.
Why single these out?
Because they can sometimes lack transparency and there's a risk they might not be at fair market value. So CARO requires auditors to report if any such non-cash transactions happened during the year.
And if they did?
Then the auditor has to check if the company complied with Section 192 of the Companies Act.
What does Section 192 mandate?
It generally requires prior approval from shareholders via a resolution for such arrangements. And the notice for the shareholder meeting needs details of the arrangement, including the value of the assets involved. Crucially, that value usually needs to be determined by a registered valuer.
A registered valuer again.
And if the company doesn't follow Section 192, the transaction can actually be voidable. The company might be able to undo it. So HEIR makes auditors check if these specific safeguards against potentially unfair non-cash deals with insiders were actually followed.
That seems like a very strong check. Okay, moving to broader compliance and governance. What about accepting deposits from the public?
This is another area with very specific rules under the Companies Act, Sections 73 to 76. Auditors have to report if the company complied with all these rules if it accepted deposits.
If not?
If there's noncompliance, or if a tribunal like the NCLT or even the RBI has passed an order against the company regarding deposits, the auditor reports that fact and whether the company has complied with the order. It notes exceptions for regulated entities like NBFCs, which have their own deposit rules.
Okay, let's unpack the next big one. Statutory dues, taxes, PF, GST, that sort of thing.
Right. This is basically checking if the company is paying its dues to the government and other authorities on time. First, the auditor checks if undisputed statutory dues are being deposited regularly.
Undisputed being the key word there.
Yes. And they have to specifically report if there are any undisputed arrears outstanding for more than 6 months from the date they became payable. This covers a whole list: income tax, sales tax, GST, customs, excise, PF, ESI.
6 months overdue. Another specific timeline. What if the company hasn't paid because they're disputing the amount with the authorities?
This is another really useful CARO requirement. If dues haven't been deposited because of a dispute, the auditor must report the amounts involved and, importantly, the forum where the dispute is pending.
So like which court or tribunal?
Exactly. Is it pending before the Commissioner, Appeals, a tribunal, the High Court, the Supreme Court? It gives a clear picture of the contested liabilities.
And it distinguishes between just not paying and actively fighting the demand legally.
It does. And again, the guidance note clarifies. Simply sending a letter to the department arguing your case doesn't count as a dispute for this reporting. It generally means a formal appeal or case has been filed.
What if the demand has been stayed by a court?
Good point. If a demand is stayed by a court or tribunal, it is considered a disputed due, and the auditor should mention the fact that collection is stayed. This clause provides real transparency on the status of tax and other statutory liability disputes.
That's really specific and useful. What about income that maybe wasn't recorded initially but then got disclosed later, perhaps during a tax assessment?
Yes, CARO addresses this. The auditor has to report if any transactions that weren't previously recorded in the books were surrendered or disclosed as income during tax assessments under the Income Tax Act. for instance, during a search or survey.
Okay.
And if that happened, the auditor needs to verify and report whether this previously unrecorded income has now been properly recorded in the company's books of account during the current year.
So it's trying to ensure that if income surfaces during tax proceedings, it actually makes its way into the official financial records.
That seems to be the main intention, yes. Promoting consistency between what's admitted for tax purposes and what's in the books, at least for these specific disclosure scenarios.
All right. What about the big one, fraud? How does CARO handle reporting on fraud?
It's a direct question. The auditor must report whether any fraud by the company or any fraud on the company has been noticed or reported during the year.
By the company or on the company? So it covers both.
Yes. Fraud by the company could be management fraud, maybe misrepresenting financials. Fraud on the company would typically be things like employee theft or misappropriation.
And if fraud is found or reported?
Then the auditor needs to indicate the nature of the fraud and the amount involved, if known.
Is this different from the auditor's general responsibility to look for fraud?
It is distinct, yes. Auditors have responsibilities under auditing standards, like SA 240, to consider fraud risks throughout the audit. This CAR reporting is specifically about frauds that have actually been noticed by the auditor during their work or reported perhaps by management or through whistleblowing during the year. It doesn't mean the auditor has to conduct a forensic investigation, but if they become aware of fraud, it gets reported here.
Related to that, what about whistleblower complaints?
Yes, for companies that are required to have a formal vigil mechanism or whistleblower policy, the guidance note says auditors should consider any whistleblower complaints received during the year as part of their CAR procedures. They typically inquire with management about complaints received and how they were handled.
Okay. Related party transactions, always a sensitive area. What does CAR demand there?
Two main things. First, the auditor checks if the company complied with the relevant sections of the Companies Act, mainly sections 177 and 188 regarding necessary approvals for related party transactions.
Like board or shareholder approvals?
Yes, depending on the transaction. Second, and just as important, they verify that all related party transactions are properly disclosed in the financial statements, as required by the applicable accounting standards, like AS18 or IND AS24.
So both the legality and the transparency.
Exactly. Did they follow the rules, and did they tell everyone about it properly in the accounts? Sometimes this involves assessing if terms were at arm's length.
And one more on governance internal audit. Is that covered?
Yes. Auditors need to report if the company has an internal audit system that is commensurate with the size and nature of its business. Basically, is the internal audit function appropriate for this company?
And if internal audit is mandatory by law?
Then they also verify if the company is complying with that requirement, Section 138. A key point added in CARO 2020 is that the statutory auditor must state whether they considered the reports issued by the internal auditors for the period being audited.
So checking if the statutory auditor actually looked at what the internal auditors found.
And if the internal audit reports weren't available or were inadequate, that would likely need to be reported too.
Okay, shifting towards more direct financial health indicators. Does CARO require reporting on specific types of financial companies, like NBFCs?
It does. If a company is required to be registered as a non-banking financial company, NBFC, or a housing finance institution, HFI, under the RBI Act, the auditor reports whether it is registered.
And if it's doing NBFC business without a license?
That also needs to be reported if it's acting like an NBFC or HFI but doesn't have the required registration. There are also specific checks for core investment companies, CICs, whether they meet the criteria and if the group has more than one CIC. It's about ensuring regulatory compliance for these financial entities.
What about just straightforward losses? Does CARO report on cash losses?
Yes. It's quite direct. The auditor must report if the company incurred cash losses in the current financial year and also in the immediately preceding financial year.
Both years.
Yes, and they have to state the amount of the cash loss for each year separately. The guidance clarifies cash loss is different from just accounting profit or loss. It focuses more on operational cash burn.
Okay. What if the company changed its main auditors, the statutory auditors, during the year? Does the new auditor have to comment on that?
Yes, this is a really significant addition in CARO 2020. It addresses concerns about auditor shopping, where a company might change auditors if they disagree, if the previous statutory auditor resigned during the year.
Resigned specifically?
Yes, resigned. Then the incoming auditor must report whether they consider the issues, objections, or concerns raised by the outgoing auditor.
How would they know what those issues were?
They'd need to get copies of the resignation letter filed by the outgoing auditor, Form 80T3, review board minutes discussing the resignation, and see if management addressed any concerns the previous auditor raised. It promotes continuity and transparency around auditor changes.
Okay, pulling a lot of this together, what's the ultimate statement CARO requires about the company's ability to, well, survive financially, pay its bills?
This brings us to Clause 19, which is a critical one, very closely linked to the going concern concept in accounting.
Right.
Based on a whole range of things, the auditor looks at financial ratios, like debt to equity, current ratio, often disclosed now in Schedule 3, the aging of its receivables and payables, any defaults, financial plans for management, other information.
Based on all that.
The auditor has to form an opinion. And that opinion is whether, as at the balance sheet date, a material uncertainty exists regarding the company's capability to meet its liabilities as they fall due within a period of 1 year from the balance sheet date.
Wow. That's a very direct assessment of short-term viability.
It is. It's a high-level flag. It synthesizes information from various sources, including some specifically required by Schedule 3 disclosures, to alert users if the auditor has significant doubts about the company's ability to pay its debts over the next year. It's a huge nugget for anyone assessing risk.
And just quickly, how does the auditor actually word these things in the report? Can they just say yes or no?
The guidance note is very clear on this. If the auditor's answer to any CARO point is unfavorable or qualified, meaning they found an issue or noncompliance, they must state the basis for that conclusion. They have to explain why they gave that answer.
Can't just say no compliance found.
No. They need to provide the reasons. Also, if the auditor simply couldn't get enough information to form an opinion on a particular CRO matter, they have to state that they are unable to express an opinion on that clause and explain why they couldn't get the necessary evidence.
So clarity and accountability in the reporting.
Exactly.
That was definitely a deep dive. We've gone through a lot of the specifics auditors have to report on under CARO 2020 using that ICAI guidance note.
Yeah.
It really paints a picture of the audit report as much more than just a sign-off on the main financials.
Absolutely. CARO provides this structured framework for auditors to highlight specific operational, compliance, or governance issues that stakeholders really need to know about, things that might not be immediately obvious just from the profit and loss statement or balance sheet.
And we definitely pulled out some striking points today. That 10% inventory discrepancy rule per class is so specific. And the detailed reporting on disputed statutory, dues the amount, and the forum. Checking the use of short-term funds for long-term assets. Verifying approvals and value reviews for non-cash deals with directors.
And that final assessment on material uncertainty about meeting liabilities within the next year, that's a big one.
These aren't just, vague principles. They're concrete checks designed to bring potential red flags right into the auditor's report. It gives users a much richer understanding of the company.
A clearer picture than the financials alone could ever provide, yes.
So connecting this back to you, the listener, whether you're looking at companies as an investor, a lender, maybe a supplier, or just someone interested in corporate governance in India, knowing these specific things are being checked and reported on gives you a much more powerful way to read and interpret an audit report. You know what mandated checks underpin that key ARO section?
It definitely enhances the transparency and, frankly, the usefulness of the audit report significantly.
This level of mandated, quite detailed reporting through a framework like CRO really does push transparency in specific financial and compliance areas. It makes you wonder, what could be the next step? The next frontier in audit reporting?
That's an interesting question.
Could we see similar kinds of mandated specific reporting requirements start to emerge for, say, non-financial areas, like a company's environmental metrics or social impact, maybe cybersecurity readiness, using a similar detailed checklist approach?
That's a fascinating thought. The model is there, isn't it? A legal or regulatory mandate for auditors to provide specific factual reporting on areas deemed critical for stakeholders. Applying that kind of specific clause-by-clause reporting to ESG, environmental, social, governance factors, or other non-financial risks. Well, that could fundamentally change corporate reporting and accountability down the line.
Something definitely worth thinking about as the world of corporate reporting keeps evolving beyond just the traditional financial numbers.